It's just 4 o'clock and you are with us on Facebook Live. Give us a minute or so to see if anyone else is going to join. This is the Low Income Taxpayer Clinic. A few more seconds and we will get our panel started. Hi, and welcome to the Low Income Taxpayer Clinic's Facebook Live, brought to you by Legal Aid of Arkansas. My name is Jennifer Gardiner, and I'm the director of the Tax Clinic at Legal Aid. We represent low-income taxpayers in their controversies with the IRS. We also educate taxpayers in their tax rights and responsibilities. Today, I have 2 guests with me to discuss tax issues. First, Brian Gray is the qualified tax expert at Vision Associates Low-Income Taxpayer Clinic in Hinesville, Georgia. Second, we have a return guest, Laurie Wehmeyer from CARE Community Clinic, a VitaSite in Rogers, Arkansas. CARE prepares thousands of free tax returns for low-income taxpayers every year. Together, the 3 of us plan to quickly discuss some mid-year or summer tax issues. Please put your questions in the chat at any time and we will promptly answer them. Please ask us some questions because we love questions. Before we start on today's topic of tax forms, we want to bring you an urgent news flash, and I mean urgent. Here in Arkansas and across the country, many taxpayers have filed 2022 income tax returns, that's this year, claiming the fuel tax credit, which increases the refund on their returns by a large amount. The IRS is stopping these returns from processing in 2 ways. Either the IRS paid the refund before they realized this was a problem and is now asking for it back, or they are refusing to process the return. It is extremely unlikely that an individual taxpayer, like you or me, is entitled to this credit, so the tax return is incorrect. So what happens next? The taxpayer needs to remove the credit on an amended return and wait for the amended return to process. If the return is not corrected, the IRS is imposing a frivolous claim penalty of $5,000 on each return, in addition to correcting the result. So don't be duped into believing that you can claim this credit or keep it on your tax return. If you or someone you know is in this situation, call us immediately. We currently have only 2 cases, but there are thousands of these in the country right now. So now turning to our topic for today, income tax reporting forms, which are given to you. So most people get W-2 forms. They work for a job where their employer withholds the tax, and at the end of the year, they get a W-2 form. If you don't work for an employer who gives you a W-2 form, but instead you work for an employer, a job of some sort, where you're getting money, but the taxes are not withheld, you're an independent contractor, or what we call a 1099 worker. You're going to get a Form 1099. And those can come either as a 1099-MISC, miscellaneous, MISC, or a 1099 NEC. That's a relatively new form. You also should get those at the end of the year, or as in after the year is over, maybe in January. But you could get them at any time. For example, if you did a painting job for a school, the school might say, that's it, that's all you're doing for us, and send you the form in September. It was just that job, so they could come out at any time. Now, we have a question, which that person almost anticipated what I was going to say next. It said, what are the deadlines for sending 1099 forms? So the employer, the person paying the money, sends you the 1099 and says, I paid you $1,000 for this job. They are required by law to send that out by January 31st after the year is over. That's the deadline. Now, some are late, some forget to do it, some never do it, but you have to wait until the deadline's passed to create a ruckus. And that, by that I mean to call the place and say, I didn't get it. Maybe they sent it to the wrong address. But you could get them at any time, in which case you really need to put it right in your tax folder for 2023 tax filing time. Now, we already mentioned that if you're a wage worker, your employer is going to withhold your income tax from your pay. That's every single time you get paid. Some of it is withheld and turned over to the IRS. Later, we're going to discuss whether or not that might be the right amount. But for an independent contractor, as we always mentioned, the taxes are not withheld. And if you earn more than $400 in a year, you're required to report the income that you earned on your 1099s on your tax return and pay income taxes. The problem is you should be paying them all year long. It's a relatively difficult process to figure out how much you need to send in, but there's penalties for underpaying those taxes. When you go to pay next April, if you earned, let's say your tax was $5,000 and you go to a Vita site, Laurie's on here and she prepares your tax return, Laurie's going to say, you owe $5,000 and you got to pay it by April 15th. But if you'd been sending in installments, say for $1,000 4 times, you'd already paid $4,000 towards your bill, and you might not have a heart attack when Laurie tells you that you owe $5,000, because instead you would only owe $1,000. Laurie, have you ever seen that situation where somebody gets really surprised?
Almost always they're surprised when they realize that they have a tax liability and that they should have been paying it on a quarterly basis. And a lot of people have no idea how much they're making, and so they're surprised by how much the 1099 NEC also is.
So our suggestion, here we are in the summer, and then the IRS sends out reminders. We're actually in the 8th month, so 7 months have passed. Summer is a good time to do an evaluation about where am I in my tax life. So should I be sending some money so that I'm not going to be penalized for underpaying next April? And so next we're going to talk, have Brian talk. Well, actually, I had another question. We have another question. We have more questions. Sorry, can't get to you, Brian. 1 second. Can I correct? Here's a question that came in. Can I correct errors on a 1099 form if I believe the information is wrong? So we handle a good number of those kind of cases at the LITC, where that's a dispute essentially between the worker and the employer, and the IRS, because the IRS already got that 1099 that says, under my example, I earned $5,000, and you're going to say, no, you only paid me $2,000. So that ends up being a big negotiation and some paperwork with the IRS to correct them. It is possible to correct them, but you can't just say, nope, I only earned $2,000. It's a little bit more complicated than that, because until it is questioned, the IRS is going to assume under the law that it's correct from the employer. And I had another question. So So when you're preparing tax returns, Laurie, do you think are there other issues for these people who are workers that you encounter?
You mean as independent
We
contractors
can't hear
versus?
you. Oh, there you go.
Oh, as in independent contractors versus the
Right.
W-2?
Correct.
Well, some of the things that they're pretty surprised at is the fact that they have to pay all of the Social Security tax and the Medicare tax. Whereas if you're an employee, you only have to pay half and your employer withholds that and they transmit it to the IRS. So sometimes they're shocked at what percentage of that 1099 that they received actually is included in income and gets taxed. And then we also have a lot of people who haven't kept very good records. And so we ask them, do you have any expenses? For instance, if you're an Uber driver, did you keep track of your mileage? Did you have any other expenses? And so we have a lot of people that walk in that we have to try to help them reconstruct and then educate them when we're trying to do a tax return for them.
So now is a really good time to do a check. Like, oh my gosh, I gotta, because it's easier to do a half year versus doing a whole year. Let's get my records in order. All right, let's jump over to you, Brian. Brian's going to talk about tax year changes. What happens when something changes in your life and how it affects your tax situation.
Hello, my name is Brian Gray. I've been involved in the LITC program since 2016, and it's a pleasure for me to help today. So we're going to go over the four circumstances, the four major ones that will impact your taxes. We're going to start with marriage. Someone who is single, you can file a tax return when you're single. There's a separate tax withholding for single. If you're married, they're going to withhold less. Your standard deduction is going to be higher, which means that the tax on your taxable income is going to be lower. Dependent births. If you have a child, the first thing that you should do is to get a Social Security number for that child, because once you do that, you will be able to get the earned income credit and the child credit. And the earned income credit especially it's a cash payment from the government, and in most cases the child credit is also depends upon the level of your income, and even if you have no tax liability, you can still get these cash payments, and helps out a lot of people. I'm going to move quickly to divorce. Divorce is when a marriage breaks up. It's sad, but that will affect your taxes. When you're divorced, you can, if you have kids, you can use a filing status called married. It's called the head of household, and you can still claim the credits that you were claiming when you were married, especially the earned income credit and the child credit, and there are some other credits also, but I'm only going to talk about the earned income credit and the child credit. When you're divorced, you're no longer married, so in some cases you can file single. And if you have kids, then you can file head of household. It depends upon when you were divorced, or if you live with your spouse any time of the year before you got the divorce decree. So that means that you're not married, and you can move on with your life as if you were single, well, you are single. So, going to move on to change in dependent residence. And this is one of the things that a lot of taxpayers tend to overlook when a child moves out of the house, if you aren't going to college, and they've taken out a number of exemptions on their W-4 withholding, and if they're not, and that's going to affect their earned income credit and the child credit, because you won't get as much if there are fewer kids in the household.
Brian, I'm going to change over to the next screen because you just mentioned W-4 and often confused with a W-2.
Oh, yes, yeah. When I was doing taxes at a major tax preparation firm, people were saying, clients were telling me that hey, I claimed 2 dependents on my W-2, and they really mean the W-4 form. The W-4 form is, in a way, doesn't have as many steps as it used to have, and you have to be careful about what you indicate on the W-4. Even though that you can put down your 3 exemptions for this or 1 exemption for that. The only reason why I would do that now is that if you have children that will qualify you for the earned income credit and the child credit. Otherwise, I would just put zeros on everything else, and even have extra withholding on line 4C. Because
so here's a confusing thing. Sorry for interrupting, but the more exemptions you put on this form, the lower the tax withholding. So that's often confusing to taxpayers. So they have to get the hang of that if they say, I get a lot of exemptions, then the employer is going to take less income tax out, and that may not be to their advantage because they'll come out owing money at filing time. So that's why you're saying be careful.
Yes, and the way that it's designed is that if you follow the directions on the following 3 or 4 pages, after that, you will wind up with just enough tax withheld, and you will most likely not get a refund, and you may even owe. So
where do you get one of these forms, Brian?
You can go to irs.gov and click on forms and instructions, and then you click on current year forms, and then type form W-4 in the search bar, and it will come up, the form as well as the instructions.
But I don't have a printer. I'm not trying to annoy you, Brian, but
yeah, well, actually, you could just download it to your to your download folder.
Well, you know what we do is we just go to payroll and they hand it across the desk and we fill it out with a pencil. So, but that gives them the heads up that you want to change it to. Can I change my withholding? And then they'll give you the W-4. So we're going to move quickly to our next summer topic, which is gambling winnings and losses. So at Legal Aid, we have lots of clients with gambling income. I guess that's a good thing. They get extra cash, but here's how it is supposed to work with gambling winnings. When you win at a casino, the casino gives you your winnings. They hand you the money, whether in cash or a check, and a Form W-2G, it's right there on the screen, at the same time. That's whether you January or July, they're going to give you the W-2G. Then you need to include those winnings on your tax return for that year, which is probably months and months in the future. You need to remember to give those forms to your return preparer like Laurie. Then you can only deduct your losses, because everyone comes to us and says, but I lost all sorts of money, up to the amount of your winnings. And only if you itemize your deductions, and this is the complicated part. For a single example, here's an example. A single taxpayer in 2022 would need itemized deductions of more than $12,950 to start itemizing. Otherwise, they would take the standard deduction and their gambling losses wouldn't count, but their winnings are still going on the tax return. So we, when people come to us about with their W-2G, with their gambling winnings, we're asking them about the losses. But Laurie, what gambling income issues do you see at the VITA sites?
A lot of the times we see that they have been habitual, not habitual, but they go to the casinos quite frequently. They forgot that they earned or actually hit a jackpot back in January, and they did it again in March and then again in September, but they didn't keep those forms, or they only kept 2 out of the 3. So when they come in, we only pick up the reported income that they provide us with the 1099 or the W-2G. And it may or may not be all of it. What we see after the tax season is when the IRS comes in and says, whoops, you had a whole lot more earnings than that. And then the other thing we see is that if, depending on the amount that they won, the casino will ask if you want taxes held out. So let's say you get a winnings of $1,200, you say, yes, hold out 20%. And so they do, and it's on that form. So they don't think they have to even bring it into us, or they even have to report it, because they already paid the taxes on it.
Mm.
So that creates a little bit of confusion to the clients when they come in with gambling winnings and or losses.
Right. And either way, if their tax return doesn't agree with the W-2Gs that were filed with the IRS by the casino, they're going to get a notice. It's not that the IRS is picking on them. The computer just says it doesn't match. Now, when that happens, sometimes they come back to you, Laurie, right?
Yes, they do.
And
Sometimes,
then other times we have people who we don't know, brand new clients, and they walk in and they say they're waiving notice from the IRS, and they say, yeah, I already paid the tax, or I lost the forms, I didn't know, and then it's never a good situation. It never works out well. But we help those taxpayers figure out how to make the best of it and try to avoid penalties and all. And we get quite a few clients that way. But the best practice is to keep those W-2Gs, and they're not 1099s, but it's in this whole summertime tax form mess, and keep those in your folder, and then you bring them to Laurie or your tax return preparer the next winter when you're doing. So another messy issue is cancellation of debt income. And we're going to go back to Brian.
Yes, ma'am. If you've ever had a credit card, or in particular that you couldn't make the payments on, and a credit card company's been trying to get you to pay, and they figured that that they can't garnish you, that they can't do anything, they can't put a lien on you, so they're going to send you a 1099-C, which means that they are forgiving the debt that you owe them. Okay, so what that means is that the amount of debt that they've forgiven, they have told the IRS, and you have to report that on your tax return as other income, but it's not all bad. Okay, there's a light at the end of the tunnel here. You can exempt some of the canceled debt, that the lender has forgiven. And so, how you do that? It's like a two-step process. There's a form called IRS Form 982, where you indicate the description of the debt, and then there's another place where you actually put in the amount of debt that's excludable. But when you file this form, you can file it with your tax return. You have to state your assets and your liabilities, meaning that what you have and what you owe at the time of the debt actually is the day before that the lender canceled the debt. Now, for a lot of you, it seems like a long time, but there are ways to actually track down what you owed and what you earned, or what you have. Assets are like cars, clothes, bank accounts, other valuables, and debts are what you actually owe. So like if you owe the credit cards, or other credit cards, if you owe back taxes, if you owe other lenders, things like that.
So Brian,
And
excuse me 1 second. So we actually get referrals on these kind of cases, and you probably do too, right?
yes, I have.
And so what happens is a lot of times the tax return preparer, maybe it's a Vita site, will call us and say, I have a client here, this taxpayer has this 1099-C, and we need to know whether they can exclude it. And that's where we go through the process of figuring out if that's possible. But the most important thing is that it's reported.
Yes. So you list your assets, and then you list your liabilities. So any part of your liabilities that exceeds the amount of your assets, that's what you can exclude from the amount that's forgiven on the 1099-C. Okay. If you have more assets than liabilities, then unfortunately you can't exclude any part of the amount that the lender has forgiven on your 1099-C. So you'll be liable to pay income tax on all of it.
So other than credit card debts, which we see on 1099-Cs, we also see auto loans, that where a car's been repossessed. Can you all think of any other ones that are common where the debt's been canceled? Those are the two things that I can think of that we usually get.
Mortgage, so like a mortgage foreclosure.
Oh, now we're talking complicated.
That's going to be a little bit more involved because the lender might sell that foreclosed home. So,
Right.
But that's
Right.
for another session, another time.
And we're going to have more Facebook Lives, and we are coming to a close here. So let's see if we have any more questions in our chat. There's one more. It says, we had a follow-up question on the gambling income, which was a really good question. It says, do casinos issue W-2G forms automatically, or do I need to request them? So that's an interesting question with regard to all of these tax forms, that if the organization, the payer, is sending it to the IRS, they've got to give it to you too. And So the casinos, as I understand it, from every casino I've talked to, any taxpayer, they literally, they don't want to mail them. They don't know, they don't think they're going to be able to find you. So they hand it to you automatically at the same time with the money. You don't need to request it. So if you didn't get one, something's gone wrong there. But you can go back to the casino, in January and ask them for the records, like a summary. And that's another thing that we didn't really talk about, is that the casinos, if you use a player card, keep track of your wins and losses. And we use those to, it's an automatic record for how, your gambling losses, and that can be used in your tax return preparation. So we've come to our half hour, and we thank you all for participating. We have 2 great panelists today, and tune in to our next Facebook Live next month in September. We're going to discuss more family law issues, which of course are ongoing and not just during the summer. And see you next time.
Hi, everybody.